Hello and welcome to financialexpress.com. I'm Shaleen Agrawal. We have with us today Rahul Jain from Edelweiss Wealth Management. Rahul, thank you so much for joining us.
Thanks, Shaleen, for inviting me for a show.
Rahul, what kind of portfolio construction is best these days?
Shaleen, I think portfolio construction, the core philosophy, if you look at, should be around asset allocation. That is the core on which the portfolio should get constructed. And depending on your age, depending on asset allocation, the construct can then move accordingly. So when the core becomes asset allocation, a easier formula, which is very practical to use also and easy for people to understand from users' point of view will be the 100 minus your age can be your equity portfolio. And the balance can be fixed income and some part can be of gold. So for example, if you are 40 years old right now, 100 minus 40, 60% can be equity portfolio. 35% can be a fixed income portfolio and 5% can be gold, where gold is like a hedge for all some things. When nothing works, then gold works. That is how the whole asset allocation thinking is, and that is how the construct can be effectively. Now, on three things, effectively, you can now start constructing your portfolio underneath. The three things is that your risk appetite, that is one. Second is if you want to make a portfolio a little complex or simple. And third is that what type of portfolio size you have effectively, because there might be certain portfolios or certain options available under the portfolio which might be a little complex. And if you have a significant size of portfolio, then only go into that, otherwise simplicity remains better. And now, suppose for hypothetically, I've given you three vectors, which is equity, fixed income, and the gold. Now they're under various uh, products available which you can use for going and achieving this. A easier and a simpler one for me is that buy large cap ETFs, buy a Bharat bond, a tax saving bonds or government taxable bonds, and then buy gold ETFs. It's very simple to construct, very simple to execute, and it will deliver you large part of thought process in terms of asset allocation. Will you be able to generate a significant outperformance alpha? The answer is no, but this is also very simple and convenient. Now, suppose you're HNR or you HNI and you want to make it more, and you want to generate more alpha effectively, then you can go into strategies like AIF in the equity basket. On the fixed income side, if your risk appetite is little higher, effectively, then you can go for double A rated entities. There are also a lot of specialized strategies coming on fixed income side, also on the AIF side, like stress assets, infrastructure strategies are there. Real estate has becoming a big strategy on the AIF side that can be also be deployed accordingly. And if you see, that is how the thinking is, that as your asset allocation remains the core, there's a simple structure available, and then below it, if your risk appetite or your size of portfolio is bigger, then you can have more opportunities available which can generate alpha for you. If you look at Shaleen right now also in the market space, and when I say ETF and I didn't spoke about mutual fund because a lot of the large cap mutual fund has not been able to now outperform Nifty also, if you see at various time horizons. Then I feel that it's better to go on ETFs. At least the cost ratios in ETFs are very, very minimal. That is one. If you look at the other important trend which is happening in the market, is that a lot of clients are moving towards AIF2 category of clients because they are looking for someone to generate alpha. And the whole space is growing significantly. As I would say that this year it has gone by 76%, last year it has gone by 100%. Now there is a 5 lakh crore commitment in the AIF2 category. And this category generally invests mostly in either private or listed companies or special situations on the fixed income side, where people are finding opportunities available. And these are ways where you can create an alpha over the portfolio or returns. And I would say that is how a person should keep his construct of the portfolio. Apart from that, a client should always have a health insurance and term insurance for himself, effectively. And that is how you should look at it.
The AIF category, it would not be very large compared to or in context of the equities or traditional debt instruments, is it?
It is the context, or I would say the percentage of AIF contribution overall is going up significantly. So now the total AIF, including all categories, around 7 lakh crores of commitment right now. And this was almost, I would say, very low 4 years back. So the size is moving up significantly. And if you see that since now people are becoming more and more comfortable with the whole equity ecosystem, they've invested in mutual fund SIPs, they have invested in ETFs, they have made return, and now they are not no more keen on doing investments on real estate for investment purposes. You remember, so there were a lot of people who were buying large houses for investment. That trend has moved away. So they had money, but the understanding of the appetite was less. As they understood it more, they now started to move into different sort of products which are available, or platforms which are available, which might need some understanding. But if you have money, then you can put your money out. So it might have higher risk, but it can also generate significant alpha as well. So that's why this whole movement structurally is happening on that category. And you will see that whole AIF2 commitments and all are also going up because clients are also wanting it to happen.
Since you mentioned it twice, I'm tempted to ask, significant is how significant alpha?
So significant alpha means that if your large cap would give you what, 10-11% right now, if you look at a larger horizon, this can generate a 300-400 basis point extra.
300-400 basis points. And how much does your risk percentage go up? If there are any figures to that?
So it'll be very difficult to give how risk percentage goes because there is no empirical formula to derive that out. But I would say that since we are running this asset allocation as a model, as a thought process, and you have anyways an equity portfolio available there. Now in that equity portfolio, if you have a good size, then some part of diversification can happen in this category. That's why I said that it depends on three categories. Once you have asset allocation under the core, then you have three categories. Whether you want to make it simple, whether you want to make it portfolio, what is your risk, and third is that what type of portfolio size of portfolio you have. If you have a good size of portfolio, then you can use this as one of the ways of improving.
I'll just stay with it for one more minute. Are you effectively saying that on large cap equity side, there is no alpha remaining now?
I would not. So I would say that obviously on large cap equity side, you can't significantly create alpha over Nifty, correct? 50, and that is also shown in the results also. So what we generally suggest to clients is that rather than doing that, go to something which is very low cost like ETF. Sure. And that's where the trend is also of significant ETF movement. I would say smart money movement is happening in ETF category regularly.
Smart money moving into ETFs. Okay, sure. What are the latest trends in PMS in terms of the advice or services or offerings that the clients are being offered nowadays?
I would say, Shaleen, that again the trends in the PMS is also very similar because people are or the consumers or investors are looking for creating value or finding value on the equity portfolio side. PMS allows that niche to come in. What is also happening that a lot of PMS is also adding AIF as a category in their portfolio itself. If you see, all large PMS guys also added a AIF category into the people because AIF as a category is more convenient from operationally. Suppose you run a PMS, then you have to maintain the contract note, taxation, the demat remains yours, etc. is there. But AIF in that sense is more comfortable. On AIF, you get more flexibility on payments in the sense that you only draw money when there is a need from the fund manager. PMS is like upfront money. Flexibility is there. Taxation in life, for example, AIF 3 categories, taxation happens at the fund level only directly. It does not, so there is no complication there. So I would say that the large part of differentiation in PMS and AIF is that the amount of required, for example, AIF requires a crore, PMS requires a 50 lakh. But thought process or thinking is largely more or similar, effectively, if you see it. That is how I would think about it. And that is how the whole conversation is happening. So that's why the AIF3 category and PMS are similar in that. So it's because AIF3 also allows you to do listed in the market. And PMS also, you will see, will be largely listed mostly in the market.
How much capital does one need to have to start thinking about getting PMS services? I mean, I know the ticket size is about 50 lakh or so, but then traditionally, does it happen that once someone has 50 lakh rupees to invest, the moment that person jumps into PMS, does it happen like that? Or
So you will find instances when people jump into it, but I will not suggest to do it. Because if you have, suppose your portfolio is a crore and you have 50 lakhs allocation right now only to equity out of that, then just stick with your ETFs mostly. And once this grows up to around 2 crore types, then put a diversification bet happening here. That is how I would suggest. I would not suggest someone who just has 50 lakh purpose to jump into PMS on day one.
you spoke about asset allocation, the formula that has been widely talked about, 100 minus age in equities and then remaining into debt and gold. The markets have behaved, very exuberantly over the last few months. And bond yields are also pretty good nowadays. So does that formula still hold, or is it some special tweaks that are required to get the most out of this in your asset allocation formulas?
So generally, I would say that large part of asset allocation formula works for every type of market, because the tweaks which you're saying and talking about right now can only happen if you're following asset allocation. Because what happens is, if your asset allocation is varied or it's not right, then what will happen that if market collapses, then you will not have any cover to reduce equity and move into some other segment. Correct? For example, if markets are collapsing, then the best time to enter into markets. What happens that time is that you might want to get rid of some debt investment and move into equity. Similarly, good time of investment in debt is also when you have booked some profits and move from equity to debt. So if you are able to do that well first, then you're largely there. Now, what you said that markets have been exuberant, markets have risen, etc. Some profit booking and movement from fixed income to debt is not a bad idea. And tweaking 10% of asset allocation on these type of situations is not a bad idea. For example, if suppose hypothetically Nifty collapses by 30, 20 or 30% for some reason, I don't know, some reason, and that time your asset allocation formula says that you should be 60, but if you're tweaking to become 70, that time I think it's not a bad idea. You can you can do so much of that much of calibration easily, and that gives you extra money to be invested at that point. Generally, you have, so there's a common saying which I keep saying that when the markets are at top, you should become fearful, and then when markets are at the bottom, you should become greedy, and that can happen, or Shaleen, that can be executed well when you have certain part of asset allocation working for you, because that gives you always a comfort level or air cover which you can start experimenting with that, or you can start putting some money at that point of time.
Then I have a simple question: how to identify if this is the top or this is the bottom?
That is always difficult, and you have been also watching markets and looking financial services very closely for such a long time, and you also know that answer is not available with anyone. But certain things like when markets are making top, some sort of profit booking, is it good? Answer is yes. You can also see that what is happening across the global peers effectively, and you can also relate that it might be little aberration here and there, and it's difficult to comment and predict. But when markets are going up consistently, some profit booking, and when markets are correcting significantly with some global reason, unlike, so for example, when COVID happened, correct? Market just collapsed, and we all knew that it will come back at some point of time, but the conviction was not there. So that is how you should look at it. Another way is to also have some price to earning model for Nifty also, which can be also used, which can also be taken into consideration. But these are very large barometers effectively, and whether you can be precisely to the end, the answer is no. But if you're able to do some calibration here and there, I'm saying that you will be in a happy space.
Sure. On the PE front, is there a magic number above which, as an investor, I should start getting cautious?
So I think something above 19, 20 is something you should be looking out for. But I'm saying that it has other variables also which needs to be taken into
Of
consideration.
course.
And also, if, for example, Shaleen, hypothetically, if you have a zero equity portfolio right now, right, and all is in debt, and you have not followed any asset allocation, at any point, I will say that you should start your asset allocation from equity right now, also whether the market is at 18, 19, 20. And that is how we look at it.
Just one more question on the valuations front. Recently, there has been some commentary that India does command a higher valuation because there is a reason for that. The factors, the macroeconomic factors, the reforms does warrant a slight premium over other emerging markets in terms of P valuations. Do you agree with that statement?
Yeah, I completely agree with that statement because India is unique in that sense because India consumption story is playing out well. India whole China plus one story will also play out and also started working it out. The whole political stability is also adding that benefit. There is a lot of, as you said, reforms, etc., which is happening consistently is also happening. So if you look at in this whole world, I think India is in that sense a different, or I would say unique right now. And will also apart from that, I think the whole internal savings which are getting moved to equities through SIP and all also now gives you a consistent amount of demand for equities structurally. So that is also extra alpha, I would say extra variable, which was not there earlier. So if you keep these five points, obviously you will find India commanding a premium. But obviously, while we command this premium, there's also underlying risk which also keeps continuing happening and impacting, or you should be well aware of is again the inflation which is spoken about it. Now people are saying that it's trending backwards again, but you have to be watch cautious about it. I think global geopolitical is still there's a lot of conversation which keeps happening again and again here and there. The US inflation is again something which needs to be watched out because the flow of money can also be significant. So I think if you are able to take these three into consideration, I think rest India commanding some premium over the emerging markets will continue. Will be a significant premium over others. The answer is that you have to watch it out for in future. And if that happens, then aberration happens, then it might be a good time to sell some and watch out for some correction.
Hmm. I wanted to ask you about some advice for do-it-yourself investors. Most of your asset allocation points have taken care of that advice, but the ones that you spoke about introducing some kind of alternative investment products, is that advisable for DIY investors? Can they do it themselves?
So I would say that it again depends on three factors that what is the portfolio size, what's the risk appetite, and then if you want simplicity. And if in this you have a higher risk appetite and if you have significant size of portfolio, whether it's DIY or you go through a wealth manager, etc., does not make difference because your portfolio constructs can be very, very similar. But generally, what I've seen with DIY customers is that they generally follow advice from a lot of advisors on the internet. They follow a lot of people on Instagram. There's a lot of conversation which is happening on the social media right now. I would say that for all the DIY customers who are trying to also, you are seeing that there's a significant upstream in the derivatives volume also because a lot of retail people are joining into the boat bandwagon of doing options, etc. And I'm not sure how good or bad it's for them. But I would suggest that if you want to create value or wealth for yourself in long term, asset allocation is the only way to go ahead with it. Without that, you might have a lot of excitement, a lot of fun. You'll have a lot of activity in while you're doing this investment. But will you end up making money over a longer term is very questionable because markets are very volatile. Apart from your understanding, your EQ also plays a very important role there, and that to manage it out is very, very difficult. And I think asset allocations gets all these things out of the picture because it allows you to create flexibility, it allows you to create some diversification, it allows you to have some calibration when the real time of taking actions come into play. So I think that is my core advice would be that follow asset allocation, and then on the basis of three criteria of your risk, the size of portfolio, or you want to make it a little simple factory. If you according to these three, then you can bucket and take up the products.
So you said that for an investor who's savvy, the kind of portfolio construction would be very similar for a wealth customer or a DIY investor. Then in that case, why should a person choose a wealth management service which does charge a fee?
So, generally, I would say that wealth management services don't charge a fee. There is not a concept of charging fees. But also, I'll tell you one thing that apart from fees as a construct, the larger part is that uh, you need you need some human intervention at various points of time. That is how I think about it because when your portfolios of 10 lakh versus your portfolio of 5 crores, the complexity of the portfolios changes and you also want to look on different solutions available. And knowing about them, explaining to you, making you understand about the same, making you follow the asset allocation model again, not moving here and there. Also, you get so much of information flow across. Now it is going up significantly higher because earlier you used to only read newspapers. Now you have mobile apps, you have YouTube, you have Instagram. So your mind also gets cluttered a lot. I think in that sense, this whole wealth manager concepts allows you to help you navigate all those times and all those conversations also.
Sure. Um, you spoke about inflation risk that should be watched for. Any other downside risks? Any other downside triggers that one must keep an eye out for?
So I think these are three one which are very now larger point which someone should look at it. I think I believe that fundamentals are very essential. I think people should not look at quarterly the numbers for India as a whole, as a sector, or as a company. And I think that is something we should watch out consistently to ensure that the assumptions which you draw upon when you invested onto certain sectors, stocks, etc., are playing out well or not.
We'll talk very quickly about debt investment right now. Bond yields have climbed up recently. Is it a good time to invest in debt, and those could those kind of returns be locked in by investors right now?
Yeah. So I think again I would come back to the older question, my construct that if your asset allocation has room for fixed income right now, which you have not done for some reason, it's a very good time, I would say, because you're getting good yields right now available. Can you lock the yields? Yes, you can lock the yields because there are NCDs available. There are debt instruments, bonds available where you can buy the higher coupon bonds right now only, and then lock it for 3, 5 year, 10 year horizon on the basis of what you want. And I think follow the core of asset allocation, and then take your decisions wisely on where you should be right now. Someone who has not done debt and been largely equity, and if your asset allocation says some part has to go into debt, then it's a good time to enter debt.
And that purchase of debt can be done through mutual funds, or does it need to be a direct debt purchase?
So I am saying you can have combination, correct? You can use a mutual fund as a route. You can use ETF like a Bharat bond debt ETF as a route. You can buy NCDs also. You can buy government bonds also. It can be a basket of those. Again, it depends.
And and
Uh,
and, and what kind of tenor should one look at right now? 2, 3 years, or 5 years, or 10 years?
so I think 3 to 5 year looks good right now.
Mhm. And held till that time.
Yeah.
So, Rahul, last question: what's your outlook on consumption story and the themes that are related to consumption and infrastructure?
So I think consumption story of India is a great story because the domestic demand across all sectors, whether it's auto, whether it is FMCG, you might have a blip in here and there in between. Whether you see the real estate consumption also, which is happening for now, I think that story is playing out well across. That story is not playing out well only on the listed space, but if you look at unlisted market also, the companies of SME and all also have been doing fairly well. So that story looks very good. I think the whole infrastructure story of India is also playing out very well because government is himself doing a lot of work there. A lot of reform is happening, and India as a country is also needs infrastructure, correct, and that will require a lot of investments. So these two stories, I think, looks good and will play out very well in coming times.
Sure. Rahul, any closing thoughts on where the equity markets are headed in near term?
So I think equity markets in near term can be volatile, and there might be some correction here and there. But if you look at India from midterm and long term point of view, I think opportunity looks very, very nice because of large reasons which are supporting India right now. One is this whole Indian consumption story. It is about whole the China plus one theme which is happening in India, the reforms which are happening in India. Also, the Indian domestic inflow is also significantly high and it remains robust. Indian savings now moving into financial assets is helping that a lot. So I think if you look this all three, it goes, and I think the whole entrepreneurial spirit, the businesses are also growing well. So if you keep that all in mind, I think India looks a very promising story from a midterm to long term point of view. I think short term is something which is very difficult to predict. It will always be volatile because your market is not just dependent on your factors, but is also dependent on large geopolitical factors also or large global factors because they're part of global economy. But generally what happens is the volatility comes from global factors, but your fundamental plays out in long term and mid term. So I think our fundamentals looks very solid. Your short term can be very volatile because of here and there news flow, things happening outside India.
Sure. Rahul Jain, it was a wonderful conversation. Thank you so much for being with us today.
Thank you, Shaleen. It was great being on your show. And as always, I enjoyed a lot.